I think it just shows you that people don't operate with independence. They operate with a bias. They think when something bounces, it's just dumb people buying, and that prevents them from jumping on with the buy. I mean, think about Palantir and Tesla, Netflix, they were all like retail stocks. I'm not trying to be snarky, but a lot of the people say, well, American exceptionalism's over. That's why I'm buying Germany, are the people that hated every rally here. And so they're trying to now create an opportunity somewhere else. We know crypto is a generational divide, because if you did the survey with someone under age 30, it's probably like 50% own crypto. But history shows pretty clearly it's people in their 20s and 30s that are driving all future change. Credit card spending shows their investment.
The 75% doesn't matter, in other words.
Yeah, or the 75% is going to flip to 75% own crypto.
Right now, 75% of people still don't own crypto, but that's about to change. When this next wave of buyers enters the market, Ethereum's value could surge past $10,000, potentially resetting the entire crypto landscape. Tom Lee, co-founder and head of research at Fundstrat, points out that history shows new technology always starts with a small group before mass adoption kicks in. In the early 2000s, broadband was rare, but within a decade it became the norm, transforming the economy. The same happened with credit cards, smartphones, and social media. Crypto is following the same path. With ETFs lowering barriers and younger investors leading the way, the 75% who don't yet own crypto won't stay on the sidelines for long. As adoption accelerates, Ethereum's price could break $10,000, reshaping the market. Stick around until the end of the video as Tom Lee explains why this adoption curve could move faster than most expect.
Stop. You don't have time. Don't miss out this 2025 bull run. Educate yourself first ahead of the crowd. We have created the ultimate step-by-step crypto cheat guide that will guide you this bull run. Unlock the secrets of crypto and make smarter investments today. Now by clicking on the link below to get your exclusive copy just under $10.
I'd say number one, just for people to place themselves like in history. So if you had a fact pattern of 20% gains, and then the third year's up 10 already, and maybe we'll be up 15 or 20 this year, then we're in a bull market. Like, so whatever.
What do you mean? Then you have confirmation that it's a bull market?
Yeah, because this never happens in a bear market. You can't have like
well,
a dead cat bounce that lasts 36 months.
You can't have bull markets and bear markets.
Yeah, but then they should then place themselves in history. This is probably more of an early start of a bull market. This one has been particularly reviled, I think, because one, the speed of the recovery has been so fast. As you know, many people rage sold in April because they're like, look, the economist told me 60% chance of recession. That's the same as a sell rating on the stock market. And they went to cash. They couldn't redeploy it because there was no pullback.
It was too fast.
Too fast.
Is that what creates a hated rally?
Yeah.
That phenomenon, people don't get back in fast enough?
Yeah, and I think it just shows you that people don't operate with independence. They operate with a bias. They think when something bounces, it's just dumb people buying, and that prevents them from jumping on with the buy. I mean, think about Palantir and Tesla, Netflix, they were all like retail stocks. Like someone was telling me the first time that they tried to buy Tesla institutionally, they had to bring in this like research firm from Oregon that wrote a report on Tesla. Okay. This is Jennison. And like, that was the first time that research firm ever got called to go to New York to actually meet a hedge fund.
Oh, wow. Okay.
So like, you know, all the really big churns come because someone recognizes it, and it's not often like the crowd that recognizes it. Start off my career as a stock analyst. Okay. So imagine we have a stock. Okay. Let's call it, XYZ. And we shot it full of holes. Like they should have been kill shots 6 times, right? Because every one of those was a kill shot for this bull market. And yet this thing...
What are the things? The inflation cycle?
Well, for COVID, number 1.
Fastest Fed hikes in history.
Yeah, and then the bullwhip chain effect was number 2. The fastest Fed hikes... the fastest inflation cycle in history, the fastest Fed hikes in history, the Trump tariff shock, and then U.S. bombing Iran's nuclear facility.
Each of those should have produced a bear market.
Yeah, should have killed the bull market. Or even killed the economy.
So what does that tell you?
Just you don't even have to know market history. Just common sense. The United States is bombing an Iranian nuclear facility. therefore buy the SPOOs.
Yeah, you never would
that
have
morning. Nobody would do it.
If you asked me in January, I'd say, okay, we got a risk of a bear market.
Right.
Yeah.
And none of these things has produced a sustainable.
That's right.
We've had like bear markets, but not a secular bear market.
Yeah. So let's say that this stock was at 16 times and we shot it 6 times over 5 years, like just kill shots.
Yeah.
And it grew earnings every year.
Yeah.
We would say the PE has to go up a lot.
And it hasn't.
It's actually lower. It's a cheaper market
It's
today.
incredible.
I'm going to 100% agree
All right.
that AI...
We can close out. Let's do favorites. All right, go ahead.
That AI is the most important driver of the global economy. Okay. But where I think people make an inference mistake, okay, is that a theme driving the global economy has been systematic to the global economy since capitalism
It's always this way.
Yeah, there's always been an industrial revolution.
Okay, fair.
And even in the 80s, the retail sector was the best group for 20 years because boomers were entering women were entering the workforce, and there was a baby boomer thing on retail stock. So that was a single theme of demographics. And like the internet boom was a singular thing of actually creating digital infrastructure. So like it's always been a story of the stock market. When you're in a big cycle like this, the winners are easy to identify because they have visibility, but it doesn't mean the losers are dead mad. But for now, they're kind of untouchable. This should be a good stock picking environment.
This one, the ISM manufacturing has been below 50 for 28 months.
Do you care about this?
Yeah, why is this bullish?
Well, because remember, this is actually one where there's no one making up the answers. Like this is a survey that's sent and people respond if things are better, worse, or the same. So it doesn't have any political bias. It doesn't have any
But the answers are biased, no? Like
the people giving the answers are not necessarily answering the question.
But if they're answering it in a negative sense, that means that they're cautious. So you can take
which is
their
what
answer
you
at face
want.
value. Yeah.
That's what you don't want this to be like a heavily bullish reading.
Correct. You never had a cycle peak when you've had ISM below. By the way, this is the longest stretch since 1950. When you have this pervasive caution in business, we're nowhere near a cycle. It doesn't get more unstable.
Okay.
You get a Fed that's dovish,
Okay.
which is cutting.
You're probably going to get that, if not now, but at a minimum by May.
Yeah. But then you need this third thing to happen. You need the excess spread on interest products to fall. Like today, if you're borrowing for a mortgage, it's normally only been at 160 basis points above the 10-year, or like 1.6%. So the 10-year's at 4.2. The 30-year mortgage should be 5.8.
But it's not.
But it's like 7. So there's excess spread on mortgages. But as
Okay.
soon as those other two things happen, I bet you that spread drops.
What is the source of that spread being so high?
It's actually hard to explain. Someone says that it's either banks worried about prepayment velocity, so because they're going to charge, so they charge an excess spread, or it's uncertainty about the value of the collateral. Like, can home prices drop so you have to charge a high rate because they're only putting 20% down?
Wait, the spread is high because they know that if and when rates drop, people are just going to prepay.
Yeah,
the
so
shit
you
out
lose
of it
money. Yeah, you're losing money.
or refinance.
Yeah, so the velocity hurts you.
Right. The
Yeah.
lenders don't want 10% of their customers saying, here's all the money, I'm refinancing lower.
Yeah, so
That's
they'll
not
make money.
great.
They want to make money on it for now on the current income.
Okay.
And then third is, of course, like the mortgage market doesn't have as much hedging and there's a QT. And so like it's harder to get spreads moved out. But for whatever reason, it's unusually wide. It's like 50 or 60 year wides. I think the simple way to think of it is like, I don't know, let's say there's 20 trillion of mortgage debt out there and like half is above that rate. That's 10 trillion times 1.6 percentage points. Like that's money in people's pockets. Plus, how many more people are going to get mortgages now that it's 5%?
I actually think the Fed has not kept rates this high for this long in a really long time. And once they appreciably fall, I don't care how bad the economy is, I actually think you could see the biggest mortgage refinance boom we've ever seen, like outside of the pandemic.
Yeah, so think about how much money that drives housing recovery and liquidity and people starting to upgrade their homes. Remember, like Home Depot said, the upgrade projects keep getting pushed out.
Tom Lee observes that the market isn't following a typical bear cycle. 3 years of steady strength rarely occur in a fading market. Events that should have shaken confidence, inflation shocks, aggressive rate hikes, regulatory pressure, and liquidity stress, did not slow adoption. On-chain activity continued to grow even as valuations temporarily compressed. Investors who relied on bearish forecasts often exited too early and missed the rebound, as the recovery came faster than expected. With institutional demand rising, tokenization accelerating, and staking integrated into new financial structures, the market is aligning for what Lee identifies as the early stage of a sustainable Ethereum bull run.
Do you think that's the next bull market is housing? I don't want to say recovery because prices are okay. A housing activity recovery.
Yeah, it's like a rethinking of shelter, because people will want to own housing, but they're too expensive. Like maybe there'll be new kinds of smaller homes being built or demand for modular, but people will borrow money to get a home.
Okay. All right. I like that idea.
Tom, are you worried about the labor market at all?
Yeah. I mean, because we know we're not tracking it correctly anymore, because ADP probably tracks it correctly, but they don't seasonally adjust correctly. And then we know the BLS numbers are different. But overall, I think the labor market is softer. I also think there's a lot less hoarding. That's why there's no pricing power anymore, right? Companies were holding on to employees. Now they're just letting them go.
Why is it so hard right now? The economy seems to be good. The stock market's booming. I'm hearing this all over the place. Talking about business school kids that should be hired. A, are you seeing that anecdotally? And B, what do you make of that data? Is it something that could get worse? Is it a blip? Like, what do you think's happening?
I think it is a big problem. I mean, I think it's observable. It's like too many things that could explain it. Because one, the
AI.
AI means there's a huge mismatch because most people aren't equipped to do the jobs that are going to be in the future available for AI. Second, I think there was this oversampling of people pursuing like liberal arts degrees expecting a job. I mean, liberal arts education's good, but we have now a huge shortage in trade workers, like massive shortage. Like it's to such a degree that AI robots are doing jobs that normally were trade jobs because there's a shortage. There's no linear careers anymore, right? It's a very different future. I mean, the market's pricing in 2 cuts between now and year end. I would say to me, 2 cuts make sense if the Fed realizes real interest rates are too high because tariff inflation is transitory. And so they should look at the break evens and realize 4.5% Fed funds versus 2.5 is 200 basis points extremely tight. If you don't even think you're going to hurt the job market, it's clearly hurting the job market. We know crypto is a generational divide because if you did the survey with someone under age 30, it's probably like 50% own crypto. But history shows pretty clearly it's people in their 20s and 30s that are driving all future change. Credit card spending shows their investment.
The 75% doesn't matter, in other words.
Yeah, or the 75% is going to flip to 75% own crypto. Ethereum, number 1, is where the stablecoin boom is taking place. 60% of it. So like this whole Genius Act, Besant says stablecoins are going to go from 250 billion to 4 trillion. That's an exponential demand growth for Ethereum.
They're replacing money market funds.
Correct. And it's dollarization and all that. Ethereum pays a 3% native yield if you stake it. So the 6.6 billion held of Ethereum is over $200 million in net income right now. The day we turn on staking, not only is there no debt on Bitminer, it's going to pay you $200 million a year in dividends.
And what do you do with that? Buy more Ether?
Or we might just pay it out as cash dividends.
Where does that 3% native yield come from? Is that gas fees that
users
are paying to use ETH?
Well, it's called proof of stake. So Ethereum doesn't have a proof of work model where you're competing for a block reward. It's saying if you hold ETH and you agree to stake it and validate transactions, you earn the staking fee, which is 3%.
Okay.
So keep in mind that the Genius Act and then SEC's Project Crypto is the recognition that using blockchain makes Wall Street faster and more efficient. I've seen it at Bitmine because like when we get the cash, the minute it touches the blockchain, it moves we have much better visibility and it's much easier to move, to actually track the money. The wallets are all tracked. And this is like 1971 because in 1971, the dollar went off the gold standard.
Yeah.
And everyone said, I'll buy gold instead. But remember, the dollar suddenly became a fiat.
Yeah.
And Wall Street innovated because they said, now we have $1. Let's make sure we can move the dollars efficiently.
You don't need to move bars of gold to match the movement of the dollars.
Correct. So it created Wall Street, came out of that single act in 1971. So now, 2025, Project Crypto from the SEC and Genius Act is saying, Wall Street, take advantage of this new technology to make Wall Street a tech industry. But they're all choosing to do it, or the majority are choosing to do it on Ethereum. Ethereum is a smart contract platform and has what they call EVMs, Ethereum virtual machines. So you can do basically a lot of smart programs and contracts. That's where Robinhood is doing their stable coins, the tokenized products on top of Ethereum.
What is the current value of all the ETH in the world? How big do you think it could get? Because working backwards, that's what the 5% stake in ETH, right?
Mm-hmm.
Okay, so what do you think?
It's about 480 billion right now of fully diluted network value.
Okay.
But
is the supply contracting or not yet?
It's actually growing about 1%.
Growing
which is
1%.
Slower than Bitcoin's inflation rate.
Okay.
It's actually a third of Bitcoin's inflation rate.
Okay. How big do you think that could be?
Well, I think that there is a very high probability, I'm going to say maybe even 50%, that Ethereum's network value will flip Bitcoin's.
According to Tom Lee, housing activity could influence cycles, but he sees Ethereum as the stronger driver. Stablecoins are booming, with the Genius Act projecting growth from $250 billion to $4 trillion, most of it anchored on Ethereum. This surge alone drives exponential demand for block space and staking yield. Ethereum offers a 3% native return, generating hundreds of millions in distributable income. Institutions are building tokenized products directly on its network, using EVM infrastructure as a new financial foundation. Lee argues that Ethereum could eventually surpass Bitcoin in network value, with the odds already reaching meaningful levels. What do you think? Is an Ethereum flippening possible? For more Daily Dose Crypto news, check out these 2 awesome videos on your screen. Click now and we will see you on the next video.